Hello everybody and welcome. This is Tushar Chande. Our big bearish reversal is truly bearish. Last week we had a outside reversal day in the S&P 500, so I thought it'd be interesting to check whether it really tests out in the long term to be bearish. So let's see what happened in our test. A gentle reminder, past performance is not necessarily indicative of future results. Hypothetical performance tests have all sorts of limitations and there's risk of loss in trading. So we had a bearish outside reversal on 23rd of May 2024 in the S&P 500 because traders were unhappy with the economic data and they didn't like the discussions about interest rates in the FOMC minutes. So even though Nvidia had delivered outstanding earnings the previous day, they got swamped by the traders' fears over rising rates. So the question for my test was, are bearish reversals truly bearish? So for the purpose of the test, I defined that open today should be greater than the open yesterday. The high today should be greater than yesterday's high. Today's close should be less than today's open. And today's close should be less than yesterday's low and the low 2 days ago. So I could have specified what I meant by big, but I decided not to do that to make the testing simpler. I used TrendSpider built-in capability, but I had to test with SPY data and not the SPX data because of their restrictions. I entered the test on the open to go short on the open of the next day after we had a big outside reversal, and then I exited after holding the trade for 3, 5, 10, and 20 days, just to get a sense for short to long-term performance. And of course, I did not specify that it should be a large bar. So remember, this is what it looks like in the most recent period. We're trying to sell on the open after a reversal day. So reversal day, sell on the open. Here we held for 20 days and exit on the open. So this is an example of a test working. And then this would be the most recent entry in the simulation where we had the reversal on Thursday and we'd be short on the open on Friday. So this is a snapshot of the summary from TrendSpider for holding for 3 days. These are our rules as I've specified them. It was a 10-year test period on SPY, short only on the open, and you see that we had a negative return for the overall test, and only 43% of the trades were profitable. So as a bearish entry and a relatively short holding period of 3 days, that didn't really work too well. This is a snapshot of the results for holding for 20 days. And a 10-year test period, again, we had negative returns for the entire period with only 37% of the short trades being profitable, and the risk by reward was about 1-to-1. So overall, not a good entry strategy. So the reversal, one-day reversal pattern was not profitable in this long-term test. So here I use the TrendSpider Strategy Variance Explorer, where I use SPY, Apple, and Microsoft with the bearish rules. This first column summarizes the results over 4 hours, daily data and weekly data for each of these symbols. And you see that overall everything was negative. So again, that just confirms that the outside reversal day is not a good entry strategy. This complicated slide summarizes my statistical testing using a spreadsheet. I'll just say that if you look at the last line, you see that the results are all less than 2. So that tells you that there's not a statistically meaningful difference between what happened after we had an entry using the bearish outside bar and just any old random point in the market. So it really again confirms that the bearish bar short entry doesn't work too well. So in summary, the bearish outside reversal pattern is not significant. Results are essentially random. It's not meaningful as a trade signal, and unfortunately that's typical result for most candlestick patterns. Thank you for listening, and I hope you'll subscribe to my YouTube channel.